Hello everyone, this is Gracie here. So in this video we will be discussing about IFRS 7 financial instrument disclosures. So what this standard explains is IFRS 7 describes what disclosure an entity shall provide about financial instrument. So in this standard it clearly explains what kind of disclosure you are supposed to make in the financial statement about your financial instruments. So your financial instruments is nothing but your investment in bonds, shares, equity, preference, and the other securities what an entity deals with. So how are you going to disclose such information in your financial statement is what is all about in this financial instrument. So, and thus it complements standards IAS 32 on presentation and IAS 39 or IFRS 9 on recognition and measurement of financial instrument. So this line states that IAS 32 and IFRS 7 concentrates, it is in AS and IFRS International Financial Reporting Standards. IAS 32 and IFRS 7 concentrates on presentation of financial instrument in the financial statement, that is nothing but disclosure, whereas IAS 39 and IFRS 9 which concentrates on recognition and measurement, that is your evaluation of financial instrument in your financial statement. Before standard IAS 32 dealt also with disclosures, but IAS 32's part on disclosure was superseded by IFRS 7. So what are the next point states that what are the items you're supposed to show about your financial instrument in the financial statement. So before that we will deal with that IFRS 7 requires disclosure of two main categories. So what is the first category is, the first category represents disclosure about significance of financial instrument for financial position and performance. The second category is IFRS 7 concentrate, that is the second category, represents disclosure about nature and extent of risk arising from financial instrument. So what is the nature and the risk which is arising from these financial instruments? So first is what, how are you going to present your financial instrument in your financial statement? How is it affecting your financial position and performance? So you're going to disclose that information, that is how your financial instrument is positioning your financial position and how it is improving your financial performance. So under your first category it explains what are the information should be to be disclosed. So the first one is information by categories of financial assets and liabilities. Yes, you need to categorize what are your financial assets and liabilities. So here in IFRS, your financial assets and liabilities are nothing but your assets are your receivables. Might be a contractual between two persons where one person is liable to pay to you, where you are a receiver of cash or any other assets. So any receivables will come under financial assets, and liabilities is nothing but where you owe to the other party through a contract to contractual aspects, where you owe to the other party will be called as your financial liabilities. So you need to categorize the information from whom you are going to receive and to whom you are going to pay. So the information about your financial assets and liabilities should be categorized. Next, specific disclosures about financial assets or financial liabilities at fair value through profit or loss, and financial assets valued at fair value through other comprehensive income. So you need to disclose the fair value of that particular assets as well as the liabilities in your comprehensive income statement or your profit and loss statement. Next, reclassification of financial instrument among categories. Yes, you'll have different kinds of instruments. So under which category will it lie on? Instruments here is nothing but your different kinds of securities. Might be bond, equity, debentures, preference, and other different kinds of shares. So under which classification are you considering it should be classified here? Next is derecognition. So here, what do you mean by derecognition is where you are going to remove your already recognized removal of already recognized assets and liabilities. So in this agreement where contractual, it is nothing but a contractual agreement. Derecognition is the removal of your previously recognized financial asset or financial liability from an entity's balance sheet. So you will be removing your previously recognized receivables and payables or any other contractual transactions from your other parties from an entity's balance sheet. So what does it mean is where you will a financial asset should be de-recognized if either the entity contractual rights to the asset's cash flow have expired or the asset has been transferred to the third party. So when you recognize this, that is your agreement is over between the other party or your asset has been transferred, that is sold out, where your ownership and the risk is transferred to the third party. Collaterals here means where it is a property or something valuable that you agree to give to somebody if you cannot pay back money that you have borrowed. So when you have borrowed some money from someone and you are not able to repay the money back, where you give some of your valuable things to them in exchange for the money what you have borrowed. So such information, if any business entity is engaged in such activities and they have rendered their or transferred their valuable properties or assets to the person from whom the money is borrowed, then such information also should be disclosed according to IFRS 7. Then allowances for credit losses. So what are your allowances for credit losses? Credit losses in the sense any credit facilities you have granted and you have incurred any losses. How have you engaged such losses and how have you adjusted such losses should be stated. Next, compound financial instrument with multiple embedded derivatives. Then how well your financial instruments are engaged in multiple embedded derivatives. When it is multiple embedded derivatives, embedded here is nothing, derivatives here is nothing but where a derivative is a financial security with a value that is reliant upon or derived from an underlying asset or a group of assets. So usually investment, it is nothing but a contract between two parties where you engage for future contracts. So where it is a contract between two parties which derives its value from underlying asset. The most common types of derivatives are future, option, forwards and swaps. It is a financial instrument which derives its value from an underlying assets. So any financial instrument with multiple embedded derivatives, you relate to such derivatives where you derive the value of it from an underlying asset. So in embedded derivatives is investing in multiple embedded derivatives is mostly due to for avoiding various risks which are arising from investment activities. If any financial instruments or if you are engaged in investing your financial instruments in multiple embedded derivatives, you need to enclose such information also here. Here, defaults and breaches of loan agreement terms, etc., indicates that if the borrower has failed to repay the loan according to the loan agreement stated, and if he is going against the law or the trust of the lender is broken, then any such information should be disclosed under IFRS 7. So information to be disclosed in relation to statement of comprehensive income is items of income, expense, gains or losses by categories, etc. So information everything to be stated in the income statement about the expense, gains, losses should be categorized. Other required disclosures refers to accounting policies applied like hedge accounting, fair value information. So hedge accounting in the sense, in order to avoid the various investment risk, what are the procedures you have taken up, and other fair value information about your assets and liabilities should be indicated here. Then, as we discussed, the second category represents disclosures about nature and extent of risk arising from financial instruments. So till now, what are the various investment sectors categories, and what are the other informations to be disclosed is stated in the first point. Whereas when it comes to the second category, it explains about the nature of risk, what is arising from such financial instrument should be disclosed. So an entity is required to present qualitative and quantitative disclosures for each type of risk. IFRS 7 then prescribes specific disclosures about credit risk, liquidity risk and market risk. So here, what are the various kinds of risk you need to state is both it is required to present qualitative as well as quantitative risk should be disclosed. So, and it also specifies that it need to disclose what are the credit risk, liquidity risk and market risk. So when it comes here, your credit risk is nothing but any money which is rendered any money which is given in the form of credit basis and which is not returned. Such risks are known as credit risk, where your borrower has not returned the money who has taken it from you. So your creditor is still pending. It is nothing but like bad debts or doubtful debts. So any credit risk comes under credit risk involves in a non-repayment of your loans, non-repayment of the borrowers loans. So when it is dealing with liquidity risk is nothing but where you don't have enough funds to meet your day-to-day activities or your working capital. So when such risk arises, it will be stated as your liquidity risk. Then market risk is where your market value of any assets increases. So trading in shares, sudden fluctuation in the price of market price leads to your market risk. So all these risks can have internal and external factors. So all such information you need to describe what is your qualitative and quantitative and the entity is required to present qualitative and quantitative disclosures for each type of risk. So you need to explain for each kind of risk what are its qualitative and quantity characteristics. That is nothing but in form of figures as well as the reason for arising of such risk. Then IFRS 7 then prescribes specific disclosures about credit risk, liquidity risk, and market risk. So next IFRS standard sets guidelines related to disclosures about transfer of financial assets. It states which information shall be disclosed when transferred financial asset is de-recognized in its entirely, and which information shall be disclosed when transferred financial asset is not de-recognized in its entirely. So all the transactions which is related to your financial instruments, its recognition, derecognition, any transfers, any sale made which is dealing with your financial instrument, all such information should be stated in according to IFRS 7. Apart from your trading or transaction activities, you need to also state what are the natures and extent of risk which is arising from trading of these financial instrument. It can be credit risk, it can be trading of financial instrument can raise to credit risk where it is nothing but non payment or repayment of your customers, not paying back, your customers not paying back your loan which you have granted. Liquidity risk where you don't have enough funds to run your business activity. Market risk where the market value is more, market value fluctuates frequently. So all these leads to your risk which can be internal as well as your external factors. So all such information should be stated in IFRS 7. Thank you everyone. The upcoming IFRS standards will be discussed in the next video.